Welcome back to CFA Program Exam Preparation. This is study session number 5, reading number 19. Today's topic is capital structure. 1. Introduction. Importance of the capital structure decision depends on the assumptions about capital markets and agents operating in them. Possible to have an optimal level of debt in capital structure level of debt where company value is maximized. 2. The capital structure decision. Capital structure debt and equity mix company uses to finance its business. Goal of capital structure mix that value and WACC. WACC equals -1. V equals D plus E. Marginal cost capital cost of raising additional capital. 2.1 Proposition I without taxes, capital structure irrelevance. Ranged under certain assumption choice of capital structure does not affect company's value. Assumption. Investors have homogeneous expectation for cash flows, no transaction, taxes, bankruptcy costs, perfect capital markets, investors can borrow/lend at risk-free rate, no agency costs, mergers always act to shareholders, wealth financing and investing decisions independent of each other. Value of company levered equals value of company unlevered. WACC unaffected by capital structure. Value of company solely determined through cash flows. 2.2 Proposition 2 without taxes, higher financial leverage raises the cost of equity. The cost of equity is a linear function of the company's debt/equity ratio. Company debt linearly, and WACC remains constant. Assumptions. No financial distress costs. Cost of debt, cost of equity. WACC, ignoring taxes, equals minus cost of equity linear function of D/E ratio. Company's asset beta equals weighted average of debt and equity beta. Minus debt ratio. 2.3 Taxes, the cost of capital, and the value of the company. After tax 1. Factors affecting value of levered company. Cost of financial distress. Agency costs. Asymmetric information. Debt adds value to company depending on corporate tax rate. Personal tax rate on interest income. Personal tax rate on dividend income. Personal tax rate in interest income greater than personal tax rate on dividends, company's value. Proposition I, with taxes. Equals _. Debt tax shield equals T times D. Assumption. No financial distress cost. No bankruptcy cost. Proposition 2, with taxes. WACC at 100% debt. 1. WACC of levered company is less than WACC of unlevered. WACC, with taxes, -1 as D but not as fast as with no tax case. 2.4 Costs of financial distress. Cost associated with company's financial distress, uncertainty of meeting debt obligations. Financial distress cost. Actual bankruptcy and financial distress cost. Probability of occurrence of financial distress and bankruptcy. Direct cost of financial distress, legal and admin fee, actual cash expense. Indirect cost of financial distress, impaired ability to conduct business, customers' loss, etc. Companies with assets having a ready secondary market, financial distress cost. Companies with intangible assets, financial distress cost. Probability of bankruptcy. Financial leverage. Business risk. Management quality. Financial distress, expected, preferred debt level in capital structure. Conflict of interest between management and providers of capital. Comprise of monitoring cost, borne by owners to monitor managers. Bonding cost, cost to align their interest with organization. Residual loss, costs incurred despite sufficient bonding and monitoring. Corporate governance agency costs. Debt in capital structure agency cost. 2.6 Costs of asymmetric information. Unequal distribution of information. Asymmetry. High-tech companies. Companies with transparent financial statements. Companies with institutional ownership. Companies with E as compared to D. Asymmetry agency costs return demanded by capital providers. The pecking order theory. Managers prefer to make financing choices that are least likely to be visible. First choice retained earnings, second choice debt, third choice external equity. Use of debt financing reflects management's confidence to generate cash. 2.7 The optimal capital structure according to the static trade-off theory. Cost of financial distress. Capital structure is chosen in a way that costs of financial distress be exactly offset by tax shield benefit. Assumption of no taxes and no financial distress costs are removed. Target capital structure. Capital structure the firm uses over time while making decision about raising funds. Value maximized if target equals optimal capital structure. Actual structure may vary from target due to the market value of securities may fluctuate. Management may exploit short-term opportunities in financing sources. 3 Practical issues in capital structure policy. 3.1 Debt ratings. Leverage ratings agencies may ratings credit risk, perceived, return demanded by equity and bond investors. Firms strive to maintain debt rating chances of financial distress, value of firm. 3.2 Evaluating capital structure policy. Consider how capital structure changes over time. Analyze the capital structure of competing firms with similar business risk. Consider company-specific factors. Need for financial flexibility. Company's cash flow volatility. Industry analysis. 3.3 Leverage in an international setting. Capital structure of a company depends upon quality of assets, profitability, chance of bankruptcy, growth opportunities and company's industry affiliations. Financial leverage across counties differ by traditions, regulations, tax, policies. While doing cross-country comparison, consider macroeconomic factors, environmental issues, financing and banking sector, institutional and legal environment. Institutional framework D/E ratio and larger debt if efficient law and legal system, auditors and analysts, taxes favoring equity. Banking systems. Financial markets. Longer debt maturity if active bond and stock market. Large institutional investors decrease D/E ratio D/E if bank-based financial system. Macroeconomic environment. Inflation D/E, shorter maturity debt. GDP growth D/E, longer maturity debt. Thank you everyone. We hope this information is useful to you. If you are willing to continue with these lessons, subscribe to the channel. To find more videos, quickly like and share the videos. You can also ask the question in comments, we will happy to answer. That is all for today. Here is some glossary for you to understand the lectures.